Wednesday, January 15th, 12:16 p.m. New York time. Welcome back, investors, to Winning Wall Street's Money. Going to discuss real estate, interest rates, bonds, yields. We have a binary event scheduled for Wednesday, January 29th. That's the Federal Reserve U.S. Central Bank meets up to vote on deciding to change or not change interest rates. Yep, that's a big event. Has a huge effect on the U.S. economy, specifically the industries related to real estate, such as mortgage companies, house renovations, buying houses. I'm going to use some terms you may not be familiar with, but right off the bat, exclusively for my Patreon members, on this Patreon posting, in the message below, I have the stock symbols for the bullish and bearish yields in the real estate stock ETF I've been sharing many times in the past for trading, for investing. Those are good financial instruments. So on the left are my watch lists. Look at that, a lot of green today. Major U.S. stock indexes in this watch list. The 11 sectors in the S&P 500 here, a lot of green. And the Magnificent Seven, a lot of green. See the stock symbol here? X-ray Lima Romeo Echo. That one sector in the S&P 500, real estate. Let's go look at the higher time frame. I want to go over yields, U.S. Treasury. You could trade the yields in the financial markets, in the U.S. futures market, U.S. equity market, and the options market, as well as the paper market. What does all that mean? Well, again, you don't have to expose yourself directly to making purchases of real estate nor the direct U.S. Treasury bonds or notes. You could trade them in the financial markets. And if you have the opinion, insight, judgment of what you think the Federal Reserve is going to do, you can have skin in the game. You can own up. Because there's a lot of talking heads talking nonsense by choice. If you don't know what the yield is, the yields affect what the interest rate is. Yields go higher, interest rates go higher. Your bonds and notes go lower. They trade inverse. Typically, when you strengthen yields, it strengthens that nation's currency. Not just the United States changes interest rates, other countries too. The major ones I'm going to go over here, 30-year, the 10-year. Yep, top left is the 30-year, top right is the 10-year, bottom left is the 5-year, and the bottom right is 2-year. These are major ones on the show. There's more. If you don't have access to the U.S. futures market, well, then you probably won't be able to trade these or see them. The numbers are different because the duration. So the longer term one, the 30-year one, is just like it says, 30-year investment. And also the yields are different in each of these. So this is why I want to show you a comparison. This is a 20-year of history. Each candlestick is a month. We're in the current month, the first month of the new year, January 2025. The first month, not done yet. But again, this is 20 years of history, the price action of the 30-year yield. So the past 30 years, here's the high, the top left. Here's the low, the bottom right. Here we are now, right here, near the top right. We took out the high of last year already. The 30-year yield is going higher. So if you want to buy the 30-year yield from the U.S. Treasury Department, it'd be locked in. Different dollar amounts you could purchase them in, but you earn a higher interest rate now than you would have last year for fixed income. Looking at the 10-year yield, here's the high in the top left for the past 20 years. Here's the low for the past 20 years down here in the middle. We also look at that this year, this month, we took out the high of last year. So if you want to be in a shorter duration, instead of the 30-year, you could go out and buy the 10-year yield right now. and earn more money on fixed income. The back end of the U.S. Treasury Department that never filled more than last year you could earn. Yep. So that's what it is right now. A little insight on a 10-year. If you have a watch list, if you're able to put it on your smartphone, I highly recommend you look at least the 10-year yield. Why? Well, in the United States, mortgage interest rates typically follow the yield of the 10-year U.S. Treasury. Yep. And then the financial institutions, the lenders, usually 2 to 3% points higher is what they add on to it to the customer. The average. If you're in a high risk, you can expect a lot more. It means if your credit's bad, live within your means. 5-year yield. Here's the high for the past 5 years. Here's the low. We are still inside the range of last year. We haven't taken out the high or low. You got it? So we're in a shorter duration, the 5-year, versus the 10 and the 30-year, the higher durations, the longer investments. Already took out the high of last year. 5-year hasn't. This is the 2-year yield. Here's the high for the past 20 years on the top left. Here's the low. Here we are now. We're still inside the range of last year. Typically, you expect the shorter term ones to be moving much more volatile. Well, it kind of looks like the inverse, doesn't it? Because it is the inverse. Interesting, isn't that? What's occurring? We have a shift next Monday of the U.S. executive branch, aka that's the presidency, is changing. Okay, unknown. Everything that's going to come out of that. But we do have this separate federal agency, independent federal agency, Federal Reserve, has scheduled events throughout the year. They're the ones that decide with their vote of what to do with interest rates, short-term interest rates, overnight lending from institution to institution. There's no other federal agency that has a vote on that. Anybody has a 2 cents on a soapbox, make a comment. Politician, private sector, you, me, we don't have a vote on it. Those people are limited what they could do in the Federal Reserve. So if you're upset about inflation, the price of goods, labor, salaries, a lot of that deals with what? Your legislative branch, your Congress, because the executive branch is limited what they could do too. And we are a democracy, and look at that, we're still existing. I want to show you now, looking at this on comparison, multiple time frames, top down. Kind of like being in an airplane above the mountains. You see far wide, but when you look at a lower time frame, you can notice maybe more insight what's getting ready to occur. So we're looking here again, 3 grids, the far right, the monthly, the middle, the weekly, and the left, the daily. This is the 30-year yield. Again, I already showed you her on the far right, broke above the high of last year. On the weekly, yep, big move up already. Again, it won't be done till the end of the week right there. And the daily. Again, the price does not move that much throughout the day. But on the higher time frames, like I show you here, the weekly and the monthly, there's a lot more price action that makes up the candles. So again, simply look, it's been trending up. Higher chance we're going to test those highs right here, maybe 2023. You earn more income now if you purchase these. Again, mentioned before. Let's go down to the next one, the 10-year one. Yeah, you could day trade these too, swing trade them, long-term invest. A lot of opportunities on these assets. And if it's going to be a long-term investment, buy and hold, which I highly recommend, you go straight to the source, the U.S. Treasury Department. Buy them wholesale, not through some broker if you want the paper. Consider buying the yearly ones, the ones that expire every 12 months, dollar cost average, and reinvest. Safer than a bank. safer than your credit union, safer than your broker. So again, we're looking here at the 5-year. We already know we took out the high of last year here in the far right. And look at the weekly and look at the daily. Take it down to the lower time frame. The 5-year, which I already identified. These shorter term ones, 5-year, 2-year, have not taken out the high of last year. So look here in the monthly. The weekly, we are trading above the high of last week, but not the high of last year yet, here in the weekly. And last week, look at that huge green candle. This was an impulse move down. Yep, we took it out, closed above it. Again, strong. Even the shorter term ones are strong, but they just haven't taken out yet those highs of 2024. And let's take it to that last one, the 2-year yield. Here we are, the monthly. Still inside the range I mentioned last year. The weekly, we already took out the high of last week, right there, the little dot. And the daily. Here we are, 4.4. You have credit cards. You have student loans. You have auto loan. Are you familiar with how those interest rates adjust, move? Different policies for different institutions. Final thing I want to show you here. The US dollar index. Again, typically when the US raises yields, aka interest rates, dollar gets stronger. Does not happen all the time. Sometimes it moves independently, stronger on its own. Looking at 20 years history, US dollar index. Yep, right here, new high. Took out the high of last year. Think about it. Higher yields, stronger dollar. Think about it for a minute. Stronger dollar gives you more buying power, but that does not mean there's not inflation in place where you're paying more for products or services. Two different words, products and services. Higher yields means if you're the investor, you earn more money on that investment, on those fixed income bonds and notes. If you're the borrower, well, you're paying more interest. You ask for it. It could go both ways. There's risk involved in those, so the other party passes that along. U.S. Treasury Department has never filled paying interest. Nope. Where you have corporate bonds and muni bonds, munis, municipalities, and corporate bonds, businesses. Over history, there have been ones that filled. So again, simply pointing out that the U.S. Treasury market is safer than corporate bonds and municipality bonds, being city and states, counties. The U.S. dollar index is just that, an index of major currencies. And those major currencies, those nations also set their interest rates. Some may take action sooner or after we make our policy. So be situational awareness that next week and the week after that, when the Fed meets, changes interest rates or doesn't, you can be aware that other nations may follow suit soon. So if you're in currency investments, told you they have an impact, correlation of what happens with the US dollar and the US yields, same with their own country. So one more time, Patreon members, exclusively Patreon members, the subscribers, the paid for one subscribers. Those stock ETFs I share often in the past, they're right here in the post below on the Patreon page. If you like early access to this video, well, I have a Patreon page I've been speaking about. You could subscribe. The link's below. That content I have is not free. So again, different subscription levels give you access to different content. Good insight. Way above what you're getting out of this video. Thank you as always for spending just a little time with me. That's it for the video. Thank you for watching.